You need to stop what you're doing. Right now, pause everything and listen, because what's unfolding in the physical silver market today, on this quiet Sunday, is not the kind of thing the financial press will walk you through tomorrow morning. They won't, because by the time their anchors have their coffee and their teleprompters loaded, the window will already be shut. Here's what I want you to do. Open a new tab. Go to your favorite bullion dealer, the one you've bought from before, the one you trust. Try to buy a 100-ounce silver bar right now, this afternoon. Tell me what you find, because what I've been documenting all morning is one of three things. You're either going to land on a maintenance page, some cheerful little "we'll be right back" notice with a wrench icon, as if a billion-dollar precious metal supply chain just decided today was the day for server updates. Or you'll see the product listed, but the buy button is grayed out, on a commodity that the COMEX claims has 366 million ounces sitting in registered and eligible vaults. Or, and this is the one that really tells the whole story, you'll find the product still available, but the premium above spot has been pushed so high that the real effective price is $10, $15, even $20 above what the futures market closed at on Friday. That is the physical market speaking, not the $67 spot price the algorithms printed Friday afternoon. The real market is a locked door with a note that says "come back Monday" at a price we haven't settled on yet. Sit with that for a second. What is a price really? A price is supposed to be where supply meets demand. Buyer wants it, seller has it. Both agree on a number, transaction done. That's a functioning market. But when the seller has the product and the buyer wants it, and the seller says no, what you have isn't a market anymore. What you have is a pricing mechanism so completely divorced from physical reality that the people who actually handle the metal, the dealers, the mints, the refiners, are communicating something through their actions that they'd never say out loud. Refusing to sell is the most powerful statement a business can make. And today, they're making it loud and clear. The paper price is a fiction. And fictions, as we've seen in 1971, in 2008, over and over throughout monetary history, they end. The only question is whether you're on the right side when they do. Now here's what makes today different from any other Sunday I've spent behind this microphone. In roughly 6 hours, at 6 p.m. Eastern, the Asian futures markets open. Tokyo, Shanghai, Hong Kong, Singapore. These aren't paper casinos. The Shanghai Gold Exchange has been trading physical silver at premiums of $8, $10, $12 above Western spot prices for months. When you buy silver there, you're buying metal. Period. No 100-to-1 leverage. No rehypothecation. No force majeure clause. You buy it, you own it, you take it. That's why their prices reflect actual scarcity. And the dealers know the Asian session is coming. That's not a coincidence. Locking down their websites on a Sunday afternoon is a calculated, rational, risk-managed business decision from people who have been in this industry for decades. They're not running out of server capacity. They're refusing to sell physical silver at a paper price they believe is about to be repriced violently upward when Eastern demand collides with the reality of what COMEX inventory data is showing us. Let me walk you through those numbers, because the numbers are the fingerprints at the crime scene. COMEX registered silver, the actual deliverable metal that backs the entire paper future system, has dropped below 90 million ounces. The last report shows 88.191 million ounces. Now let me put that in context. Back in October 2025, total COMEX silver inventory, registered plus eligible, was 532 million ounces. Today it sits at 366 million. That's a 31% decline in 5 months. Almost a third of the silver in Western vaults has walked out the door. In the registered category alone, the stuff that's actually available for delivery, the drop is 32% in 4 months. That's not seasonal. That's not normal drawdown. That's a systematic, relentless drain of physical metal heading east. And we know it's going east because of what happened to lease rates. In October 2025, the cost of borrowing silver in London spiked to 34.9% annualized. Let that number land. Normal silver lease rates run below 1%. They hit nearly 35%. That's not a market anomaly. That's a market screaming that it's running out of real metal to lend. Let me now explain the dealer's perspective, because this isn't emotional or irrational. These are hard-nosed, margin-calculating businesses that have survived in this industry through discipline and pattern recognition. Say you're a dealer holding 50,000 ounces of physical silver. The COMEX spot says it's worth $67 an ounce. So on paper, your inventory is worth $3.35 million. But you know from talking to refiners, from watching Asian order flow, from watching your own restock costs climb, that replacing those 50,000 ounces won't cost you 67. It'll cost 75, maybe 80, maybe more by the time you factor in shipping, insurance, and the 3 weeks it takes to move metal across the Pacific. So you don't sell. You're not being irrational. You're being exactly as smart as a business has to be to survive. You're not giving away real, tangible metal for paper dollars priced off an exchange with a coverage ratio of 13.4%. That coverage ratio is the number you need to burn into your memory. It means that for every 100 ounces of silver represented by COMEX paper contracts, only 13 ounces are actually sitting in a vault ready for delivery. The other 87 are a promise, an IOU, a paper claim on metal that doesn't exist in deliverable form. 13.4%. The dealers have always known this. But today, with the Asian session hours away, they've decided the risk of selling at the paper price outweighs the cost of losing a day's revenue. That tells you everything about where they think price is going. Now let me walk you through 3 historical moments, because history doesn't repeat, but it does rhyme hard enough to leave marks. August 15th, 1971. Nixon goes on national television and tells the world the United States is temporarily suspending the convertibility of the dollar into gold. Temporarily. That was 55 years ago, and that temporary measure never ended. At that moment, gold was fixed at $35 an ounce. Foreign governments had been showing up at the Treasury with dollars, demanding physical gold, and the vaults were draining. The paper-to-physical ratio had become unsustainable. Sound familiar? So they closed the gold window and changed the rules mid-game. Within a decade, gold ran from $35 to $850, a 2,400% move, because the paper fiction collapsed and physical reality took over. Then 2008, Bear Stearns, Lehman Brothers, an entire derivatives complex built on mortgage-backed securities rated AAA that were in reality worth nothing. The paper said safe. The actual houses, the actual borrowers, the actual default rates told a completely different story. When that fiction collapsed, the global financial system came within hours of total failure. The Secretary of the Treasury literally got on one knee and begged Congress to pass the bailout. That is what happens when paper promises meet a physical reality they can no longer absorb. COVID freezes global supply chains overnight. Silver futures on the COMEX crater to $11 an ounce. But you couldn't buy a physical silver eagle for less than $20 or $25. That's a 60 to 100% premium over the paper price. The paper said $11. The physical market said try $30. And which one turned out to be right? The physical market. Within 18 months, the paper price had caught all the way back up. The physical market is the leading indicator. The paper market always follows. It just takes time. Right now, the physical market, through the locked dealer doors, through the blown-out premiums, through the drained COMEX vaults, is telling you the same thing it told you in each of those moments. The paper price is wrong. Again. Let me show you the math on where this goes from here, because the math doesn't lie. The April 2026 COMEX contract, a major delivery month, has its first notice day 2 business days out. and there are still 1,726 open contracts. Each contract represents 5,000 ounces. That's 8.63 million ounces of potential delivery demand against 88 million ounces of registered inventory. Nearly 10% of the entire deliverable inventory could be demanded in a single contract month. Across all silver contracts, open interest represents paper claims on hundreds of millions of ounces. The leverage ratio is 7.5 to 1, 7.5 times more paper than deliverable metal. If just 5% of contract holders stood for delivery, the system would crack. If 10% stood, it would break. And the delivery pace has already been accelerating. December 2025 saw 46.6 million ounces delivered, roughly 50% of total estimated free float registered inventory in a single month. January 2026 saw 33 to 40 million ounces delivered, 7 to 10 times the historical January average. At the current withdrawal pace of roughly 333,000 ounces per day, the registered category reaches zero in approximately 163 trading days, about 8 months. The reality is, the pace will speed up, not slow down, because as inventory shrinks, urgency rises, which drains inventory faster, which raises urgency further. It's a self-reinforcing spiral. The market will seize up long before it hits zero because traders will front-run the exhaustion. When registered drops below 50 million ounces, panic begins. Below 25 million, every short position in the market scrambles to cover simultaneously with no metal available to buy. That is the definition of a gamma flip. The rehypothecation chain snaps, force majeure gets declared, and anyone holding paper silver gets a cash settlement at whatever price the exchange decides, not the market. This is exactly what the LME did in the nickel squeeze of March 2022. Nickel ran from $25,000 a ton to over $100,000 a ton in a single session. And what did the London Metal Exchange do? They canceled billions of dollars in trains, literally reverse-settled transactions, and told the market those prices didn't count. They changed the rules mid-game to protect the shorts. When silver does what nickel did, and the structural math says it will, the same playbook gets run. Force majeure, cash settlement at an exchange-determined price. If your silver exposure is through an ETF, a futures contract, or a pooled account, you get that paper price. But if you're holding physical, if you took delivery, if you pulled your metal out of the system entirely, you get the real price. The price the dealers are refusing to sell at today. Stick with me here, because this doesn't live in a vacuum. The silver market sits inside a global financial system that is restructuring, whether the West admits it or not. The U.S. national debt crossed $39 trillion on March 17th of this year. It took 200 years to build the first trillion. Now we're adding $1 trillion every few months. Interest payments alone are projected to exceed $1 trillion in fiscal year 2026, more than the entire defense budget, triple what we paid in interest in 2020, while the debt itself grows at $7.23 billion per day, $301 million per hour, $83,000 per second. The government is now borrowing money specifically to pay the interest on money it already borrowed. That's not a fiscal strategy. That's a Ponzi scheme. And every Ponzi in history has ended the same way. Paper holders get wiped, real asset holders survive. Meanwhile, the BRICS nations are doing something entirely different. China's central bank has been buying gold every single month. India's silver ETF inflows are surging. The Shanghai Gold Exchange is pulling physical metal from London and New York at a pace that's visibly draining Western vaults. They're not doing this because of any particular analyst or channel. They're doing it because they understand the arithmetic. A $39 trillion debt growing at $7 billion a day, backed by a central bank that can't raise rates without crashing the housing market and can't cut rates without reigniting inflation, is a currency in its terminal phase. Not eventually, right now. The terminal phase isn't an event, it's a process, and we're inside it. Here's where the gold to silver ratio becomes critical for your positioning. The ratio currently sits around 64 to 65, meaning it takes 64 plus ounces of silver to buy 1 ounce of gold. Historically, that ratio ranges 40 to 60. In major precious metals bull markets, it compresses sharply. In 1980, it hit 15 to 1. If gold is around $4,500 today after pulling back from its all-time high of $5,062 in January, and the ratio compressed to just 30 to 1, silver would be $150. At 20 to 1, $225. At the historical extreme of 15 to 1, $300. And that's with gold staying flat, which it won't, given that every force driving silver is driving gold even harder. If gold moves to 7,000 and the ratio compresses to 20 to 1, silver goes to $350. That's more than 5 times today's paper price. The dealers locking their doors today aren't thinking about $67. They're thinking about what it's going to cost them to restock next week, next month, when their replacement price is 40% higher than the number on the screen. This is what a V-shock looks like before it happens. Not on the price charts, on the dealer websites. The charts catch up later. They always catch up later. The physical market leads. The paper market follows. That's been the pattern in 1971, 2008, 2020, and it's the pattern right now on this Sunday afternoon, 6 hours before the Asian markets open and the repricing begins. Drop a comment below if you tried to buy physical silver this weekend. Tell me what you saw. Maintenance page, grayed out buy button, premiums through the roof. Let's build the real-time evidence base together, because this information isn't being documented anywhere else. The financial press won't tell you the buy button doesn't work on a Sunday. That's what this community is here for. There's a fundamental, irreconcilable difference between a paper claim and a tangible asset. A paper claim is a promise from a counterparty, from a bank, from an exchange, from a government. And promises, as the last 20 years have made painfully clear, get broken the moment they become inconvenient for the people who made them. A bar of silver in your possession is not a promise. It's not anyone else's liability. It's not subject to counterparty risk. It's not going to arrive as a letter informing you that due to extraordinary market conditions, your metal has been converted to a cash settlement at a price someone else determined. It's there. It's real. It's yours. In a world running on $39 trillion of debt, growing at $83,000 a second, with a COMEX coverage ratio of 13.4%, and dealers refusing to sell on a Sunday afternoon because they know the paper price is disconnected from reality. In that world, the gap between a paper claim and a physical asset is the gap between being whole and being wiped out. I'll be watching the physical premiums in real time as we cross the 6 p.m. Asian Open tonight, and tracking institutional liquidity into Monday. This is a critical 48-hour window. Make sure you're subscribed with notifications on so you don't miss the follow-up, because by the time CNBC explains why silver moved overnight, the move will already be history. The people watching right now are the ones who won't be caught off guard. If you want to see how I'm personally positioning my portfolio to navigate this disconnect, my physical to paper ratio, my entry points, my exit strategy, hit the join button and come inside. I break it all down every week for members. Not financial advice, just transparency. One person showing exactly what they're doing with their own money while the market pretends $67 silver makes sense when you can't actually buy it for that price. The clock is ticking. 6 hours to the open. The only question that has ever mattered in the history of money is the one dealers are answering today by locking their doors. Do you trust the paper or do you trust the metal? The paper is a fiction. The metal is real.